Hi everyone, this is Tim Melvin of the Banking on Profits newsletter service, and I'm here today to talk to you about something I like to call the double compounding effect that's going to be the secret to making so much money in the small bank stocks over the next decade. Now, I've talked enough about it. We all should have a pretty good picture of where we are right now. Banks are just putting the credit crisis in the rearview mirror. We're finally starting to see the credit picture improve a little bit. Loan demand's not really picking up, but it's better than it was, and the economy's slowly but surely getting a little bit better all the time. So these banks are still sitting here. There's no institutional notice. Their stock prices have not gone back to the same multiples of tangible book value as they were pre-crisis. So right now you can still pick up a whole bunch of small banks at 75 and 80% of tangible book value, and these are quality sound banks. And we're about to see the double compounding unlock the value of these stocks, and investors with the patience and discipline to be involved in this sector could easily make 10 times their money or more over the next 10 years. I've seen it twice before in my career happen, and I believe and see no reason it's not going to unfold in exactly the same manner going from this point forward over the next decade. We saw the same thing in the pre-savings loan crisis back in the early 1990s. And then, of course, everything went down back when the internet bubble went boom, and the small banks were no exception. They went down, but then the double compounding effect kicked in, and investors made several times their money over the next several years. It's going to happen again. I'm going to try to get you in position to take advantage of it, but let me explain to you exactly how it works. Now, it's no secret, as I said, we're looking to buy these little banks at about 80% of tangible book value. So let's just use some easy numbers. Let's say we've got Bank A, it's trading at $10 a share. We're able to buy it at $8. We're pretty happy about that. We got a nice, sound little financial institution at 80% of tangible book value, which, as Marty Whitman once told us, that usually works out pretty well. Now, the economy will get a little bit better. Housing market will continue to stabilize. It's not going to get better this year, but over the next couple years, it gets a little better. And Bank A just kind of plows through the regulation, deals with the problems. It's an enormous headache, but they're able to grow a little, and they increase their book value over 5 years by an average of about 5%. Not unreasonable at all. So book value is now $12.75, and let's look over a couple of scenarios that could happen. Now, first, let's talk about takeover multiples. That's the price that one bank is willing to pay for another bank as a percentage of tangible book value when they do a deal. So right now, the multiple is 1.3 times on average that banks transactions have been conducted at. So let's say that multiple stays exactly the same. So now we've got a bank. If the bank just trades up to the 1275 book value, it's gone from 8 to 1275. That's not bad. That's a 9.77% return. Nothing to dance in the streets about, but that is actually before dividends, so that's in excess of the long-term market rate of return, so not too shabby. Well, let's say Bank B comes along and says, look, I'm trying to grow in this region. Organic growth's still a little slow because there's a lot of bank branches. You've got a great network, a great loan book. Bank A, I want to buy you. Bank A says, after the last 5 years, we've had some success, but I got to admit it's been tough working late nights, not much fun being a banker anymore. Bank B, I'm going to sell it to you at the prevailing price to book value multiple of 1.3 times. That, my friends, is a 15.93% rate of return on the stock if, in fact, they do a deal at that multiple of tangible book. But here's what happens when these consolidation waves get going. We're going to start at 1.3. As banks are in better condition and there's more demand for bank deals, because remember, the regional banks are a part of this equation. It's very difficult for them to grow in a very crowded marketplace in a very slowly growing economy. So their path to growth to make their investors happy is going to be to buy some of these banks. Going to be more demand for these small banks. What happens when there's more demand? The price goes up. So 5 years from now, maybe we're halfway through this cycle. We've gone from 1.3. Now the average takeover multiple is 2. And I've seen this play out, as I said, over time, 2 times in the 1990s and in the 2000s. It's going to happen exactly this way again. As book value is growing, so is the multiple of tangible book value that acquirers are willing to pay. So if our little Bank A now sells out to Bank B at the new prevailing multiple of 2 times, that's a 26% compounded rate of return. We're starting to make some pretty serious money on our little $8 a share bank that we bought. Now, here's where the magic kicks in. We've been bought by Bank B, so now Bank AB is, we're a nice big bank. Maybe we've gone from a $600 million bank. Now we're part of a $5 billion bank, let's say. And from our $5 billion bank has a $25 book value per share. And we're going along. They're growing book value at 5% a year. They're doing deals, acquiring, competing against the big guys. And at the end of 5 years, they've done a nice job, grown book by 5% a year. It's now 31.90. But now we're deep into the cycle. And takeover multiples have soared. They're up to 2.75, which is just a little bit below where the prior two huge bank consolidation waves topped out. Now, Bank C comes in and says, you know what? I'm a $10 billion bank. I need to get bigger. You're a $5 billion bank. Let's do a deal. At the current takeover multiples, I think I can make you really happy. The guys at Bank B say, well, geez, we didn't really want to, or Bank AB, I'm sorry, we didn't really want to sell. But at 2.75 times book value, I think our shareholders might kill us if we don't go ahead and sell this bank to you for $87 a share. Now, our little $8 has gone to $8.87 over a period of 10 years. That's a compound rate of return of 27.06%. I don't know of any mutual funds and very few hedge funds that are earning that type of rate of return on your money. Your 8,000 has grown by a factor of 10. So that's the double compounding effect. The book value of the bank is growing, and so is the multiple that acquirers are willing to pay for our shares. So it's compounding on two levels. Book value is going up, so is the multiple of book value that will get paid in a takeover deal. Takeover deals are not inevitable for every bank, but they're highly likely for most banks with less than about $3 billion of assets right now, and that's the ones we specialize in banking on profits. It's the double compounding effect. It can make you an enormous amount of money, and of course, since it's part of a takeover, it's usually not a taxable transaction until you finally do sell those shares 10, 12, 15 years from now. This money can just keep continually growing on a tax-deferred basis for an extended period of time. Small banks are cheap right now. We can buy quality small banks. We've got a pretty good list of them in the portfolio that you can buy, as I said, at 75, even just 80% of tangible book value right now. These stocks are going to multiply. I think they're going to multiply 8, 9, 10 times over the next decade. It's an opportunity to make an enormous amount of money to fund your retirement, send your kids to college, whatever your hopes and dreams are. Double compounding in small community banks can help make them come true. This has been Tim Melvin of the Banking on Profits Report. Thanks for listening.